Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Bob's in Hawaii outside, hence why he's looking the way he does. We're going to talk about the market. Market's been trying to grind higher here. People think it's a new bull market, but we're going to show you some charts here that are going to give you pause as to where this market might be headed next. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So Bob, you and I have been talking about how this market resembles what happened in 2008, but it's also got some, especially when it comes to tech, very, very, very similar looks to what happened in the dot-com bust. Another time where it seemed like we were in a new paradigm, new tech is here, and the world's never going to be the same.
Yeah, so this is my third time that I've been in this environment where what I would call the smart people were getting nervous, but they were looking stupid, and the dumb people were crowing, but ended up broke. And so I was in software in 2000, Phil, and we were actually a cloud company before they called it cloud company, and so a lot of people were panicking over Y2K. So we were getting business left and right, kind of like AI is today. Everybody was buying new hardware, Sun Systems, because you were in the space on the ISP side. And then we started the new year, and everybody said, the market's going to crash, blah, blah. And then nothing happened, and we kept going up. Mm-hmm. And we're selling and selling and selling. And then all of a sudden, our sales dropped off after January. And then the market kept going higher. And then March, we kind of imploded. And then flash forward to 2006 with real estate, same thing, new paradigm, people are buying, cheap money, smartest thing in the world. Bush is out there saying everybody gets to own a home, blah, 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 blah. Took 2 years. And then smash, and then brings us to today. And so I want to show you a chart that kind of ties that conversation in, if you don't mind, Phil. Okay, the chart that's in blue is Cisco that was pushed back 2 years from its peak. The red chart is NVidia. And this is what an Eiffel Tower looks like, guys. That's what I said about when you look at an Eiffel Tower, what do you call these blow-off tops, is that they'll retrace 87% of that base before the rip. And that's where NVIDIA is. So we can expect when this thing's all said and done, and by the way, it took 2 years for that base to build and fire higher. It took 1.5 years for it to collapse. And those first moves are a doozy. And so we're at that point right now where we're at that second part of the doozy, if you will. And we showed you other charts that, when they talk about it's everything's okay chart, and then roll over hard. So we're at that point now where we're starting to see the second rollover. And I've never ever seen in my entire trading career or anything I've ever read where a blow off top is preceded by even a more blow off topper. Right.
Yeah.
So I think this is a problem. And I know I was traveling yesterday, but I know you were talking to people about, and I'll give you the floor here before we get on to our next charts. So you were talking about, hey, if we start seeing island tops, we should probably get a little worried. So did we see any island tops today in the market?
There was a few names that had island tops. And in fact, NVIDIA, which I was specifically talking about, started the day off, opened with an island top, and then it closed that gap. But I still think that what causes island gaps are blow off top environments, and some of these names have indeed put in those island tops. So when you start seeing those formations, and that's just simply where the candles go up sharply, and then on one day they gap up, and then the next day it gaps down, and it looks like you have a candle on an island up there, and it's a very bearish scenario. I think it's a much more powerful signal this week, given what's going on with the debt ceiling and all the other stuff that we've been talking about, and Yellen having to reissue debt and how negative that is for the market. So you have a culmination of things that make for a very bearish point in time here. And island tops in that scenario, I think, are just a gimme when it comes to a short or a hedge or just getting out of that particular stock name.
Yeah, and one thing too is that you and I are getting some grief from some people. Maybe they're just trolls about why you guys so bearish. Look how great things are going, but are they really going that great? This next chart we're going to show you is, and I'll give you an anecdotal from my side, is I have a broad-based 401k plan that it's broadly represented, with what I would call the best of the best of Dow stocks, the best of the best of S&P, the best of the best of the energy sector. And in that environment, Phil, from January to now, we're slightly red in our portfolio. And I don't really trade that portfolio too much. I sell calls against it. And in that situation is that I've been generating more and more cash, but I'm not going anywhere. Right. And, obviously I'm not in the top 10 NASDAQ stocks. And the reason why is this chart we're going to show you. Chart should scare the hell out of you.
On one hand, you can say, well, this is comparable to 2008 because 2008 had a fairly sustained bear market rally, ultimately a lower high, and then it rolled off rather quickly and then, sent the market to new lows. On the other hand, it's also reminiscent of 2000, the dot-com bubble. And if you notice here, this is the NASDAQ versus small cap. So it's basically the Qs versus the Russell index, the ratio of that. And you'll notice what this means is that tech's getting way ahead of the rest of the market. And small caps is usually your canary in the coal mine. So what this is telling you is that the disparity between tech and small caps is so large that we're rivaling the situation in the dot-com era. And I'm just thinking that, it's basically an unsustainable ratio. When tech it's basically stretching the rubber band. Think of those peaks as the rubber band, and it wants to mean revert back down. So, whether or not we get an Eiffel Tower like we did in the dot-com era, which I think the macro environment makes that possible. But even if we don't, and we get, the snap back down like you saw going into COVID, that's still a substantial drop for this ratio to go back down. So worst case scenario, we don't, we take out the lows and that's about it for the bear market. Worst case scenario, you do get more of a dot-com thing, and it's a more drawn out, longer type of bear market, which is what the yield curve is implying, right? That we actually go through most of 2024 without really much of a rally. So you have to really have your head in the sand when you have these types of ratios that are historically very accurate when they get to these levels, and not think that, we're at risk here for a significant correction. So if you're not preparing yourself, or at least getting a little bit defensive here, and you think it's just, just keep buying the dip, I think you're going to be in for a rude awakening here, Bob.
Yeah. And look, right. You put out one scenario. Let's just say we're both wrong, and then the small caps start catching up to the NASDAQ 100. The market will still sell off because everybody will race out of the NASDAQ 100, which is the market cap waiting for all the indexes, and run into what's moving in the small cap environment. So there's no scenario in which we just go to nirvana. We're going to visit Dante's Inferno first. And people just need to be very, very careful. We showed you guys last week, once Yellen has to start borrowing money in the amounts that she has to, the market has no choice but to go down, because the Federal Reserve is not supplying liquidity. And retail is not going to run out there and buy Janet Yellen's bonds. As the bond yields keep going higher, they're just going to keep putting more and more of their money into money market funds and into the 90-day Treasury yields. They're not going to be chasing after her auctions. And then the big money is just going to step back, and it's going to just give, the bond market price will rise. Price will fall, yield will rise, and that'll also affect the market. So in my view, there's no scenario is going to be bullish, until we come out of this recession.
Agree. And another thing I'll point out too is the 08-09 correction, severe, the great financial crisis. This ratio wasn't even stretched. It just looked normal, because you don't have to have a stretched tech ratio to have a market sell-off. However, when you do have a stretched tech ratio, it is going to sell off. So, This is why it's just really dangerous environment here. We're being held up by toothpicks. Think of these little spikes as toothpicks holding up, heavy load. It's just not going to last, guys. The ratios are unsustainable because the rest of the market's looking the other way. I mean, if you compare the NQ chart to the ES chart in the last 24, 48 hours, ES is much weaker. And there's no environment where the ES is weaker and tech's just off, going to higher highs. It always mean reverts and snaps back down. And that's where we are today. And in fact, those spikes there all saw a broad market rally. S&P was grinding up, Dow was grinding up. In this situation, we're getting this ratio and the markets haven't gone anywhere. In fact, we are looking at lower highs. Okay. So we're in a much weaker, broadly speaking, we're in a much weaker position having this rubber band stretched here than we were in previous examples. And so this is a much more dangerous situation this time around.
Totally agree, Phil. Hey guys, if you like this video, hit like, hit subscribe, hit notification, and check out the rest of the week here. As soon as the Yellen and this House deadline passes, we should see some fireworks in the market. But if it doesn't pass, we may be seeing fireworks before the deal gets done too. So a lot of things to talk about. Take care.
See you guys later. Bye-bye.